Hello everybody and welcome to this CACEIS webinar series, today in partnership with S&P Global, which theme will be debunking the myth around securities lending, performance, regulation and opportunities in 2023. The goal of this webinar is, first of all, tackle the misconceptions that we might have around securities lending by outlining the role, the essential role it plays in market liquidities, also the fact that there's strong regulation around this activity, and also that we can generate revenues and have a sustainable approach in terms of portfolio management. So first of all, I'm going to introduce the speakers and present you how this session will go down. So first of all, we will have an industry performance overview with Matt Chesum. Hi, Matt.
Hi, Tony.
Thank you for being with us today. So Matt Chesum is Director of Securities Finance at S&P Global. He will reintroduce what S&P Global does, and he will take you to an overview about who are the market participants, where they are physically, geographically, and what are the assets that are very well in the securities lending industry. Then we'll go to the second part that I will present. So it's a way for us to reintroduce what regulation is about when it comes to securities lending and sustainability, and also answering some common questions about performance, technology, and in general, what are the challenges for this industry in the coming months and years. So it's a way for me as well to reintroduce myself. I'm Donia Ruigueb, Head of Sales for Securities Finance and Repo Activity at CACEIS. Then we will pass the ball to Remy, who's a senior sales at CACEIS, still on the Securities Finance and Repo activity. He will detail CACEIS tailor-made offers and solutions and how CACEIS can answer to our clients' queries and requests when it comes to defining a framework for an optimal securities lending program. At the end of this session, we will have time for a Q&A moment, so please do not hesitate. If you have any question, you can send them directly on LinkedIn, and we will try to answer them as much as we can, so we'll have a small moment at the end. So I pass the ball to Matt, who will present the industry overview for 2023.
Hello everybody, so my name's Matt Chesum and I'm here representing S&P Global Market Intelligence. At S&P we provide data to the securities finance markets. We offer an independent proprietary database that provides daily transparency into the securities financing markets. The main source of our data is from prime brokers, custodians, asset managers and hedge funds. The data is used by the market primarily to assist in the pricing of securities finance transactions, but also in identifying intraday liquidity risks, in benchmarking portfolios, and in identifying potential short squeeze risks in the market as well. So, over the last 18 months, a combination of drastic change in monetary policy, an increase in the level of geopolitical risk, and a greater market volatility in general has really created the perfect environment for securities lending transactions to take place. Now, revenues during 2022 reached their highest level since 2008. $12.5 billion worth of revenues were generated by the securities finance markets throughout the year. Now, during the first half of 2022, the lending of equities generated about $4.7 billion worth in revenues, and the lending of fixed income assets generated around $1.3 billion worth of revenues. Now, as you can see, during the first half of 2023, revenues have increased further, with equity revenues increasing about 15% on 2022 levels, and fixed income revenues increasing by about 23% when compared with H1 2022. Now, during the first half of 2022, the average lending fee for fixed income assets was around 17 basis points, and the average utilisation, which refers to the percentage of a portfolio that's typically lent, was standing at about 15.21%. Now, for equities, The average lending fee was around 73 basis points, and the average level of utilisation was standing at about 3.84%. Now, as can be seen, average fees have increased for both asset classes during the first half of 2023 as well. Now, in line with 2022, the vast majority of revenues have been generated through the lending of American equities and corporate and government bonds. The pace of change to monetary policy has really created a lot of opportunities for borrowers of fixed income assets in particular over the last 18 months. Having access to assets that can easily provide liquidity and the increased levels of volatility basically that have been seen in the yields of short-dated government bonds as a result of the rapid increase in interest rates over the last 18 months have really both been important drivers of demand in the securities finance markets. Now, US equities have been one of the largest contributors to revenues over the past year. In-demand stocks that have been commanding very high lending fees have been important contributors to revenues. One example of this is the cinema company AMC, which has been the biggest revenue generator of 2023 so far, generating over $450 million worth of revenues alone. Now, the electric vehicle sector has seen a lot of interest this year from borrowers, as has the technology sector and the property sectors. So, moving on to revenues by lender type, asset managers, pension funds, insurance companies and sovereign wealth funds are probably the most common participants within the securities lending market at the moment. Now, if we use full year revenues for 2021 and 2022, we can see that asset managers have generated the largest share of market revenues over both of these years. Now, during 2022, asset managers generated $800 million more in revenues than during 2021, and this represents an increase of 24%. This was the largest increase year on year across all market participants. Now, asset managers tend to hold a very broad range of assets within their funds, and this really makes them perfect for securities lending. The diverse range of both strategies and investment types both ensure that whatever market conditions are, asset managers usually hold assets that borrowers are interested in borrowing. Pension funds tend to hold a high proportion of high-quality liquid assets, particularly high-quality fixed income assets, and as a result, the revenues that they're able to generate are usually linked to market requirements for additional collateral and government bonds. Now, passing over to global average lendable balances, this slide shows us that the average lendable balances by client type. And as can be seen, the vast majority of assets come from asset managers and pension funds. Now, during 2022, the size of lendable assets available to be borrowed were on average around $31 trillion. 58% of all inventories came from asset managers and 20% came from pension funds. Now, what's interesting to see here when we look at average on-loan balances by client type is that even though asset managers were have the largest lendable inventories, it's pension funds that generally have the largest proportion of their assets out on loan, followed by asset managers and then sovereign wealth funds. Now, in relation to on-loan balances, on average during 2022, $2.36 trillion worth of stock was being lent on any particular day. Pension funds typically accounted for around 36% of all on-loan balances, with $850 billion worth of stock on loan, whilst the asset managers and sovereign wealth funds had just under $580 billion worth of stock on loan, which accounted for around 25% of all on-loan positions for each of those two client types. Now, this really comes down to the fact, as we mentioned before, that pension funds typically hold and lend a lot of their high-quality liquid assets, and as a result, this pushes up the on-loan value for this particular client type. Now, another metric that has been increasing over the last year or so has been a widely used metric that we call return to lendable. Now, this metric shows the average basis point return that's been generated on an average portfolio over a year. Now, as can be seen, the average return increased significantly during 2022 for both equities and corporate bonds, which is very good news for lenders, as it means that on average they'll be earning higher revenues across their portfolios. Now, to conclude, as can be seen from all of these slides, the securities finance market is very, very well established and generates some very meaningful returns to market participants. During the first half of 2023, revenues have increased 17% on what was the best year since 2008 in 2022. As seen, average utilisation declined across both equities and fixed income assets during the first half of years, but revenues increased to $7 billion. Now, the size of the market also continues to grow. Whilst total value of assets may have declined slightly to around $31.6 trillion worth last year, and that was mainly due to a fall in market valuations during the last quarter of last year, when we look over a 5-year period, there's been a steady increase in the number of available assets in the lending market. Now, this suggests that fund managers continue to look increasingly towards securities lending to really help them to reduce expense ratios on funds and to increase their investment returns. Now, on that note, I'm going to pass over to Donia, who's going to carry on with the presentation.
Thank you very much, Matt. Thank you for this overview. So we're going to move on to the regulatory landscape. I think that, first of all, when we talk about securities lending, there is something that we all need to bear in mind. This is an OTC market. So what the regulators want in general is transparency, it's fluidity between market participants. So when it comes to an OTC business, unlike the listed industry, there's work to do. So the main three themes, I would say, that the regulators are trying to tackle is transparency, liquidity and settlement discipline, and best execution. So if we start with transparency, the regulators want the beneficial owners and more generally the market participant to disclose as much as they can about the activity they're performing. How can they do that? They can do that by imposing, for instance, some reporting. We all know about SFTR, for instance, this regulation that came into force in 2020, where all the securities finance transactions need to be reported to a trade repository. And these represent 150 fields, even a bit more, for each transaction that we need to report. So this is an example, clear example on how regulators are working on this transparency theme. Another example is the fact that we need to disclose in prospectus when it comes to funds about the securities lending activity. If the fund is able to do so, who are the providers, and so on. The second theme, very important for the regulators, and it's not just about securities lending, actually, it's about the markets, financial markets in general, is liquidity. We, and I think this is the good timing to talk about debunking the myth around securities lending. We all know now that securities lending is allowed by regulators, but more than that, regulators are for securities lending if well regulated, of course. Why? Because it helps market liquidity. For instance, when we talk about settlement discipline, if you do securities lending, then you can fluidify your settlement if you have some failing transactions. So very important to tackle this idea that securities lending is participating to market efficiency. The third theme is best execution. When it comes to best execution, and if we again think about the fact that we are in an OTC business, this can be challenging because by definition we don't have the exhaustivity of all the transactions done by all the market participants. But at the same time, we had data providers. S&P Global is a clear example, who can gather data from market participants, the main market participants, and then help us define a benchmark. This will not be a perfect benchmark, but still, it is a benchmark. So when you talk and when you think about securities lending, about entering securities lending, you need to think about these three themes. When we talk about the borrower and the lender, so we go in much more details. When it comes to final lenders, we identified three main topics, they are addressing right now. CSDR, and I'm going to tell you why CSDR is linked to securities lending. Because CSDR, for those who don't know, is regulation where we, as market participants, need to settle on time our transactions. Otherwise, we will have some penalties. And there's also, it's not confirmed yet, but in discussion, that at some point there will be automatic buy-ins. A lot of discussion around that, but so far it has not been withdrawn. So how CSDR securities lending is linked? It's quite easy. Through securities lending, you can borrow securities and so help avoid settlement issues. So CSDR is a big topic for the final lenders. For UCITS funds, there's a main topic around transparency in general. The fact that you need to disclose more and more what you do when it comes to securities lending. I will not go into too much details, otherwise we will not have the time, but this is something with the new UCITS regulations that need to be addressed. And SFDR is the third main topic when it comes to regulation and securities lending that our clients, beneficial owners, are trying to address. But I will talk about it later because we will have a focus on sustainable securities lending activity. When it comes to borrowers on that part and service providers, there are two main themes that are emerging. And it's important also for the lenders to know, because this will have an impact on the way borrowers will behave with them. The first one is, in general, balance sheet constraints. We all know that after, it's been a while now, but Lehman in 2008, but for the past more than a decade, it's now 15 years, there's a lot of regulation that has been put in place, so the financial institution in general and banks in particular will have to strengthen their balance sheet capacities so they could face liquidity shock or a systematic crisis. What is the consequence for securities lending? It's the same consequences as for other business for banks and financial institutions. It costs in terms of provision. We talk a lot about, for instance, RWA. So the implication is that for the borrowers, they will have higher costs in terms of balance sheet. And so they will select better the activity they will do with the lenders. So it's important to bear that in mind. I take a very concrete example. Now, a borrower is facing a fund. The fund doesn't have a rating. So when the borrower borrows security from the lender, he has an exposure against the fund. But the fund has no rating. He has to do the right provision on his balance sheet. It costs a lot. So maybe tomorrow the fact that a fund is technically an unrated counterpart, this might be an issue, and maybe borrowers who would prefer to borrow from rated counterparts. The second big debate as of today is regarding agency models. As most of us know, there are two types of models when it comes to securities lending: principal and agency. The principal model is when the lender is facing an entity and the service provider then, lends on the street their securities. But technically, he has just one exposure, the lender, right? When it comes to the agency model, technically, even if the service provider is doing securities lending on behalf of the lender, from a risk and legal point of view, the lender is in front of the borrower. And in that case, it costs in terms of balance sheet. Why? Because all the agent lender offer what we call an indemnification clause. What is an indemnification clause? Is the fact that if the borrower does not give back the securities, all right, to the lender, then the lender will have the collateral. But maybe the collateral is not enough to buy back his position he did not get back. In that case, the service provider, because of this clause, will indemnify the difference between collateral and the value of the loan. And this is what costs a lot for agent lenders. So there's a big debate around it. We'll see where it goes, but one thing for sure, if you need to take away one thing from this slide, is that costs are rising for borrowers. They will be more selective around when they face the lenders. And for lenders, the thing to keep in mind as well is that because of the regulatory landscape, they will need to bring more transparency, more discipline in terms of settlement, and prove the best execution. Either they do securities lending themselves, which is the case for big clients because they have the staff to do so, but also for smaller clients because they will act through their service provider, but still they will need to control what their service provider do. If we move on to the next slide, and we think it's very important to outline these two topics. The first one is technology. We all know, and it's not just linked to the securities lending industry activity, technology today is key. It's key, why? Because we live in a complex world, more and more complex world. We manage a lot of flow. To give you an idea, we've seen some figures, but roughly we've observed between 20 to 25% more volumes when it comes to securities lending between 2021 and 2022. It means more volumes to manage. In the same times, we had SFTR, CSDR, other regulation, reportings. So in order to manage all these constraints, the best answer is technology. The good news is that we have technology. When we see, for instance, here at CACEIS, our front office desk are mainly engineers that develop their own tools. We also integrated machine learning to our daily activities. So we are trying to automatize as much as we can, but still automatizing doesn't mean that the machines are doing things by themselves. It means that we decide how to automate. This is for the technology part. Regarding the performance, because this is what the reason why we are here today, first of all, keep in mind that as Matt outlined before, 2023 and 2022 were the best years ever in terms of securities lending for the reasons that Matthew detailed, so I will not come back to that. So we don't know, actually, if the revenues will still be that high. Wish we knew. But the good news, again, is that we can see, like now, current opportunities. First of all, opportunities on the collateral. I give an example, the pledge collateral. As of today, borrowers, because of the constraints we talked about, they have interest in entering securities lending transactions using pledge as collateral. So as a lender, you know that if you can accept pledge, there's some extra value you can extract. Another example is the collateral matrix. Why? Because we have more and more lenders coming in the industry of securities lending, because it's a safe activity, because you receive a collateral as a guarantee. So you lend your securities. If you have to sell the securities, you get back your securities. In the meantime, you have collateral. But we have seen that because of there's a lot more supply, there's more competition on the lender side. So the borrowers will go to the lenders who has more flexibility. So if, as a lender, you are able to enlarge your collateral matrix, you will have more appeal for borrowers. So there's still some work to do on this part. Another theme, I will not go into much details today, but if you're interested, I'm happy to discuss further with you, is the central clearing counterparts. It's a solution that would allow borrowers to optimize their balance sheet conception. And so because it's an interest on the borrower side, by definition, it might be an interest for the lender side, because the lender wants to go where the borrowers are going. And I would say, apart from this collateral opportunity, you also have more general opportunities. We all know that because of the end of the TLTRO, there will be more opportunities on the lending, because you will have some sell side who will be looking to enter what we call collateral switch transaction, for instance, which is basically the fact that you lend a type of asset against another type of assets. The most famous one would be government bonds like OAT or Bund against equities. That's the most common. And this type of transaction, you could do it on a term basis, not on an open basis, but like on a 3 months term, 6 months, even over a year, because the financial institution who have interest in paying for this type of transactions, they are interested as well on having this transaction on a longer maturity because it helps for some ratios constraints. Last but not least, we've seen a regain of interest in the cash reinvestment, but I think it's very important to outline that cash reinvestment is an investment. It means that, yes, you can take cash as a collateral on your securities lending transaction, and this cash you can reinvest it. But this reinvestment, if you do not choose carefully where you're going to invest, you might lose this cash. So it's about the risk appetite that lenders have. As of today, there's not such performance for very short-term investment because you need to have this reinvestment available in case you close your lending transaction. So unless you have very big risk appetite, there's not that much interest in terms of basis points yet, but still to keep in mind. So this is about, I would say, the environment in 2023 for securities lending. Keep in mind, technology, a lot of investment from buy side, sell side, and service provider to manage higher flows and constraints. Performance as its highest so far, but still a lot of opportunities that might lie ahead, depending on the flexibility of the lenders. We still have time for this last part, which is very important, either for CACEIS, that for our clients, of course, is the theme of sustainability. Sustainability for us, it's very important. We know it's here to stay, and we fully take part and validate the concept. Still, we have a lot of questions regarding securities lending and ESG or SRI. Can I enter securities lending transactions and be compliant with an ESG or SRI approach? The answer, the consensus so far by the industry is yes. How can we see that? For instance, we can see that no regulators, when it comes to sustainability, forbid securities lending. Actually, the debate is wider than securities lending. Regulators are trying to find common ground to set up some rules because so far it's the topic is still very much discussed. But if I take an example, labels. If I take the ESR label, which is a French sustainable label defined by the Ministry of Economy, the French economy, you can see that securities lending is allowed. So I think it's pretty clear that regulators has nothing against securities lending and sustainability being put together. Still, you need to build a program that fits with your strategy. And this is where the main consensus is. The market participants, and when I say market participants, I mean associations, I mean lender, borrower, not just only banks. They develop a 5 pillars approach. The fact that the first pillar, you need to select your service provider. Your service provider needs to have a sustainable approach. The second pillar is to be transparent and to have ethic when it comes to securities lending. So disclose what you do. If you do securities lending, disclose how much you take for the service, how much will go back to your portfolio, inform the investors. The third pillar is select your counterparts. The same way you select your providers, the same way you select the securities you're investing in, you need to select your counterparts. The fourth pillar is about collateral. This pillar is very much discussed because some participants say, I need to apply the same criteria on the collateral as I accept as the criteria I apply when I invest. But by doing so, apart from the fact that it can be technologically complicated to manage, because if you say, I don't want to invest in oil, then when it comes to collateral, how do you want to exclude oil? Are you going to exclude securities from an index? Are you doing eyes in by eyes in? It can be very challenging. So when it comes to collateral, a lot of discussions. The fifth pillar, which is very much important, is about voting to general meetings. And again, there's a lot of discussions around it. Why? Because when it comes to securities lending, we didn't go back to the fundamentals of securities lending, but we need to take a one step back. It's a temporary transfer of title. So it means that you lend your security, but technically it's still yours. And the collateral you receive is a protection. So technically it's not yours. It becomes yours the day that the borrower does not give you back your securities. So you have all the flows that are entitled to you, like dividend or coupon, they need to be paid by the borrowers to you. So it's completely transparent for you in terms of economic flows. But when it comes to voting, it's not the case. Because as you know, when it comes to voting, you need to be physically holding the share. And the borrower cannot show to the lender if he voted what the lender was expecting. So if you want to be sustainable and generate revenues on your securities lending program, you shall recall securities to vote. Now, the rules about recalling might vary. Some clients say, I'm going to recall just part of it, my position. Others will recall everything. But what we always say is, it's not just about recalling. Saying I'm going to recall all the securities and not going to vote on all the securities doesn't make really sense. So to conclude on this slide, you need to keep in mind that securities lending can be completely compatible with a sustainable and very profitable securities lending program. But you need to define the framework. And for that, you have people like us, asset providers, who can help you. So I pass now the ball to Rémi, who will detail the product offer CACEIS is sharing with its client to help them address this challenge and help them build successful securities lending program.
Thank you very much, Donia. Good morning, everyone. So after this global overview of the market, so we will focus on the CACEIS service offer. So first of all, this slide is presenting you the global markets that our team is trading on. So based on Luxembourg, thanks to technology, our team has access to almost all the markets where the securities financing is traded. So it's a global presence and trading on almost all assets and all assets that could be trading under securities financing. I mean equities, fixed income, sovereign bonds and corporate, convertible bonds, ETFs. This team of experts has large knowledge thanks to presence of seniors, managers and traders and development technology to increase the performance and to keep it the highest as possible. Now going to the next slide, we can see the three main activities that are managed by this desk. Sorry. So first of all, on the top of this slide, you can see the securities lending. Securities lending could be managed under two different models, as explained Donia earlier, and the agent model, for example, or the principal model. Both models could be offered to our clients depending on their appetite to face different borrowers. For example, this is under an agency model, or if they want to remain with only one counterparty. So CACEIS principal model. The service provider that we are has to recommend to our clients what will be the best model to maximize the revenues with the inventory they are in their holdings. The second main activity is the securities borrowing. So now that CSDR entered into force last year, most of our clients understood that to cover and to avoid CSDR negative penalties, it would be very important for them to cover their failing positions. So CACEIS has developed two main products to cover their clients, the fail coverage and the auto borrow. The fail coverage is done under an on-demand service where the client comes to our desk and locates the stocks or the securities, and he borrows and returns when he is long again on his position. The auto borrow is a tool that CACEIS has developed, which is screening the positions of the clients when we are close to the cutoff settlement, identifies the short position that have to be covered, and then deliver the securities to the client to allow the client settling their sale. So this product, securities borrowing, is very important first to offer a service on the discipline of settlement to our client, but also to help them to avoid paying negative penalties into the market, and thanks to the positive penalties to make additional revenues. And then the securities financing is the third big offer that we have on the desk. The asset switch that is very requested, a lot of demand on asset switch currently. Donia explained that the end of the TLTRO has already started until end of year, but this end of TLTRO has increased the demand for a switch of collateral, OAT versus equities, for example. The repo solutions, when we are lending or borrowing cash from our clients, could be also a solution that we see a lot of demand increasing as well. And because of the current rates, some clients are asking to borrow cash. So what the securities that they are holding in their portfolios, they give us under a repo structure, and we lend them cash, and they reinvest the cash on their side. So this product is very increasing currently. So now we have seen the main products that we are offering on the desk. We will go to the next slide to explain the 5 key points that CACEIS has in his offer. The first one is the expertise that we developed a bit earlier, and with a team of very recognized people in the market, awarded and strong professional. The second one is the security, thanks to a very strong framework in the process, the control, the compliance, and the risk is very well managed at different levels. The third one is the performance and technology. So how desk is developing a lot of tools in order to manage the volumes and to maximize the revenues for our clients. The transparency is the way that we are giving to our clients some reports, offering them the possibility to manage their exposure and their loans every day, and also the performance report that we are building thanks to a contribution to our data providers. So Matt, who represents here S&P Global, for example, is a data provider who is benchmarking all the products that are trading in the market, in the industry. And then the last key point is the tailor-made offer that CACEIS is giving to its clients. So the capacity to make exclusions on the assets, lendable assets, but also on the eligible collateral, and then also the capacity to give to our clients the rights back on the account and help them to vote at the general assemblies. Now we have passed the service offer from CACEIS. We can go to the Q&A session. So with Donia and Matt now back with us.
All right, thank you very much, Rémi. So we have like just a few minutes to answer some questions. I'm gonna read the first one. The first one is for you, Matt. I guess you mentioned that you mentioned that the lending of equities generated 5.4 billion during the first half of the year. Can you please break this down by geographic region?
Yeah, sure. Very interesting question. So I do happen to have the numbers in front of me, luckily. So looking at what's happened over the first semester of 2023, we can see that EMEA equities have generated in the region of $966 million, American equities $2.8 billion, and in the APAC region just over $1 billion. So I think, as you can see, it's really a lot of the revenue has been generated by the US.
Yeah, definitely. And this is something that we actually have been seeing amongst our clients, that securities, US securities are generating a lot of revenues this year. All right, so moving to the next question. I would take this one, is what is the difference between securities lending and repo? A very good question indeed. We had it on the French session. There's a lot of confusion sometimes between these two types of transactions. So technically, legally, they are different, but still. When we talk about repo, and actually in English, sometimes people think securities lending and use the word repo, but repo, repurchase agreement, is more like a treasury tool. You have treasurers, they know that they can do repo with the securities, get the cash and reinvest the cash somewhere else. Otherwise, maybe pay things. We have, for instance, some institutional clients who use the cash from their repo to finance some acquisitions. That's an example. When it comes to securities lending, it's more about performance per se. You want to lend, for instance, this US equity because it's going to generate a fee, a very important fee for you. So it's about performance versus treasury, let's say, reasons. But the truth is that now, when it comes to securities lending, you can use the collateral, because collateral is in securities but can also be cash, to do financing with it. And on the repo side, when it's primarily used as a treasury tool, you can now do repo on specific bonds that are very well, you will be very well paid for it. So there's kind of a blur line between these two activities. But I mean, to recap, this would be the main difference. Last question, and I will let Rémi answer this one, is why the auto-borrower service should be interesting, knowing that the counterparts who does not deliver the securities in the first place will indemnify me.
Yes. Okay. So as explained just a bit earlier, so with the CSDR regulation, you have positive and negative penalties due to for the discipline of settlement, and many of our clients understood that if they are covering their fail to delivery, they will get the positive penalties directly on the account and make additional money. So this is very important to understand that you could avoid negative penalties, and CACEIS is able to make assessment on your portfolios if you want to identify the possibilities to cover and to avoid negative penalties.
Okay then, I think that's it for us. We have already passed our timing. So I would like to thank very much Matt for coming today and S&P Global for supporting this webinar. If you have any question, please do not hesitate through the social medias, LinkedIn. You can also reach us through CACEIS website and S&P, I guess, website. So,
Sure.
All right, thank you very much. Have a nice day all. Bye.
Thank you.
Bye.